A major shift is unfolding inside the US banking system, and almost nobody is watching it closely enough. Not because the data isn't there, not because the warning signs don't exist, but because the system has learned how to hide stress in plain sight. What you're about to hear is not a prediction, not hype, and not fear-driven speculation. It is a structural analysis of incentives, balance sheets, and liquidity mechanics that explain why today's banking system looks calm right up until the moment it doesn't. Most people believe banking crises start with panic. They don't. They start with accounting. They start with unrealized losses. They start with maturity mismatches. They start with refinancing walls that quietly grow larger every month while nobody is paying attention. And by the time panic arrives, the outcome is already mathematically locked in. In this video, we're going to walk step by step through what is actually happening beneath the surface of the U.S. banking system, why commercial real estate is now the primary stress fracture, how the refinancing maturity wall works, why unrealized losses stay invisible until liquidity pressure forces them into the open, and why regional banks, not Wall Street megabanks, are most likely to feel the first real shock. This is not financial advice. This is a systems-level breakdown of broken market plumbing. On the surface, U.S. banks look stable. Deposits appear steady. Capital ratios look adequate. Equity markets are calm. Credit spreads are not screaming danger. The headlines are quiet. But that calm is artificial. It exists because accounting rules allow banks to classify massive bond and loan losses as unrealized. As long as those assets are not sold, the losses do not hit earnings. As long as deposit outflows remain manageable, banks are not forced to sell. As long as the Federal Reserve backstops liquidity, markets assume the problem is contained. This creates a dangerous illusion. It creates a world where balance sheets are technically solvent but economically fragile. The U.S. banking system today is sitting on hundreds of billions of dollars in unrealized losses, primarily on long-duration Treasury securities and fixed-rate loans issued during the zero-rate era. These assets were priced for a world that no longer exists. When interest rates rose, the market value of those assets collapsed. But because banks are allowed to hold them at par value, if they are classified as held to maturity, the losses simply disappear from view. Not eliminated, just hidden. And hidden losses are far more dangerous than visible ones. Unrealized losses only become real losses under one condition: forced selling. Banks are not hedge funds. They are maturity transformers. They borrow short and lend long. Deposits can leave tomorrow. Loans mature over decades. As long as deposits remain stable, banks can pretend their long-duration assets are worth face value. But when deposit outflows accelerate, the illusion collapses. To meet withdrawals, banks must raise cash. To raise cash, they must sell assets. And when they sell assets that are deeply underwater, the unrealized losses instantly become realized losses. That is the trigger. Not fear, not headlines, not speculation. Liquidity. Every modern banking crisis from 2008 to 2023 follows this exact script. The system looks stable. Losses are hidden. Deposits quietly drift out. Then one institution hits the liquidity wall. And suddenly everyone realizes the emperor has no clothes. Commercial real estate is not just another asset class. It is the single largest concentrated risk on U.S. regional bank balance sheets. Office buildings, retail centers, hotels, multifamily housing, industrial parks. These loans were originated during an era of ultra-low interest rates, cheap refinancing, and rising asset prices. That world is gone. Today, refinancing rates are 2 to 3 times higher. Property values are falling. Occupancy rates, especially in office, are structurally impaired by remote work. This creates a mathematical problem. When a commercial real estate loan matures, the borrower must refinance it. But the new loan terms are worse, much worse. Higher interest rates, lower appraised values, lower loan-to-value ratios. Higher debt service costs. Many borrowers cannot refinance at all, which means defaults are not a choice. They are a mechanical outcome. Here is the part almost nobody is talking about. Commercial real estate loans do not default randomly. They default in clusters, because they mature in clusters. Between now and 2027, trillions of dollars in commercial real estate debt must be refinanced. This is called the maturity wall. It is not a theory. It is a schedule. Every month, another wave of loans comes due. Every month, borrowers discover that their properties are no longer financeable at acceptable terms. Every month, banks are forced to either extend and pretend or recognize losses, and every extension pushes the problem forward while making the ultimate loss larger. This is how slow motion crises form, not through sudden collapse. Through rolling mathematical inevitability. Large Wall Street banks are not immune. But they are not the primary transmission mechanism. Regional banks are. Why? Because they hold a disproportionate share of commercial real estate loans. Because their deposit bases are less stable. Because they have less access to capital markets. Because their unrealized losses are larger relative to equity. And because they cannot easily raise fresh capital without signaling distress. This creates a fragile equilibrium. Everything works until it doesn't, and when it doesn't, it breaks fast. Right now, the system is being stabilized by 3 artificial supports. 1, a regulatory forbearance. 2, accounting flexibility. 3, central bank liquidity backstops. These supports are not permanent. They are political. They are discretionary. And they are conditional. They exist only as long as the problem can be framed as temporary. The moment losses become too large to hide, the moment inflation constrains bailouts, the moment public anger limits rescues, the rules change. And when the rules change, balance sheets reprice overnight. Here is how this spreads. Step 1, CRE defaults rise. Step 2, bank earnings deteriorate. Step 3, equity markets notice. Step 4, depositors move funds. Step 5, forced asset sales. Step 6, unrealized losses become realized. Step 7, capital ratios collapse. Step 8, regulatory intervention. Step 9, panic. This is not hypothetical. It is the mechanical pathway of every modern banking crisis. Forget headlines. Forget pundits. Forget stock prices. Here are the real signals. A bank deposit flows, CRE delinquency rates, LIR office vacancy rates, E refinancing volumes, E bank equity to asset ratios, E unrealized loss disclosures. Federal Reserve liquidity usage. When these move together, the outcome is no longer uncertain. This is not a housing bubble. This is not subprime. This is not a leverage crisis. This is a duration and refinancing crisis. It is slower. It is quieter. It is more politically complicated, and it is harder to fix, because there is no obvious villain. There is only math. The most dangerous phase of every financial crisis is the phase where nothing appears wrong. That is where we are now, not at the end, not at the beginning, but in the invisible middle, where losses are hidden, where refinancing walls are growing, where liquidity is quietly tightening, and where most people still believe stability is real. It isn't. It is borrowed time. If you want early alerts and exclusive updates as this story develops, join the premium WhatsApp channel. If you want deeper research, more data, and full structural breakdowns, join channel membership. If you support original work and want to eliminate copycat content, comment OG John AG. And if you're doing well financially right now, share your success story below. It helps others stay motivated and learn what's working. A strange thing is happening inside the US banking system. Nothing looks wrong. There are no crowds outside branches. No viral videos. No emergency headlines. And yet, money is leaving the system faster than at any point since the last crisis. Not in a panic. Not in a crash. But quietly. Systematically. Logically. What you are about to hear is not a story about fear. It is a story about incentives. And once you see the incentives clearly, you will understand why the next banking crisis will not start with a bang. It will start with a spreadsheet. When most people hear the words bank run, they imagine chaos. People lining up, ATMs running dry, police at the doors. That image is outdated. Today's bank runs happen in silence. They happen inside mobile apps. They happen inside Treasury departments. They happen inside corporate cash management accounts. In 2024 and 2025, hundreds of billions of dollars quietly moved out of regional banks and into money market funds and Treasury bills. Not because depositors were scared, but because depositors were rational. Why earn 2% in a checking account when you can earn 5% in a government money market fund? This is not panic behavior. It is optimization behavior, and optimization behavior is far more dangerous to banks than panic because it doesn't reverse. For decades, banks relied on something called sticky deposits. Customers were lazy. Switching banks was annoying. Interest rates barely mattered, so deposits stayed put. That era is over. Today, anyone can move 50 Zallows from a bank to a money market fund in under 60 seconds. With 2 taps. No friction. No paperwork. No phone call. The entire funding model of the banking system was built for a world that no longer exists, and no one updated the architecture. Here is the trap. Banks cannot raise deposit rates enough to compete with money market funds. Why? Because their assets are locked. They hold long-term bonds and fixed-rate loans paying 2-3%. If they pay depositors 4-5%, they lose money on every dollar. So they face an impossible choice. Option A saying raise deposit rates and destroy profitability. Option B saying keep rates low and bleed deposits. Either way, the math is ugly. There is no third option. Banks are sitting on massive unrealized losses, not from bad loans, not from reckless speculation, but from buying safe government bonds at the wrong time. When interest rates rose, bond prices collapsed. Those losses are hidden under accounting rules. They are invisible until a bank needs cash. Then the losses become real, instantly. When a bank sells one underwater bond to meet withdrawals, 3 things happen. The loss hits earnings. Capital ratios fall. Markets notice. Then depositors notice. Then more deposits leave. Then more assets must be sold. This is not a spiral. It is a cliff. Once it starts, it does not stop. Forget bonds for a moment. The real danger is commercial real estate. Office buildings, hotels, retail centers. These loans are rotting quietly, but not because tenants stop paying, but because refinancing is impossible. Interest rates doubled. Property values fell. Loan terms no longer work. So banks are extending loans and pretending nothing is wrong. This is called extend and pretend. It always ends the same way. Between now and 2027, trillions of dollars in CRE loans come due. Every month. Another wave hits. Each wave forces banks to choose. Recognize losses now, or delay and make them bigger later. Politically, delay wins. Mathematically, delay loses. Regional banks hold most CRE loans. They also have the weakest deposit bases. They also have the largest unrealized losses. They also cannot raise capital quietly. This is not a coincidence. It is design. They were built for a low-rate world. That world is gone. This is the part people misunderstand. The next crisis will not look dramatic. No Lehman moment, no overnight crash. Instead, one bank cuts its dividend, another raises emergency capital, and another merges quietly. Another fails on a Friday night. And then one morning, people realize half the regional banks are gone. If regulators step in and bail out banks, inflation worsens, public anger explodes, moral hazard grows. If regulators do nothing, the banking system shrinks violently, credit disappears, the economy stalls. There is no painless option. Forget headlines. Forget earnings reports. Forget political speeches. Watch only 3 things: bank deposit flows, CRE delinquency rates, money market fund assets. When these move together, the outcome is already decided. The next crisis will not feel like a crisis. It will feel like the system slowly stopped working. Loans harder to get. Rates higher. Banks disappearing, growth weaker, and no clear moment when it all broke. That is how modern crises work. Imagine waking up tomorrow and realizing that the banking system you trusted for decades has quietly changed. No alarms. No news flashes. No dramatic collapse. Just a slow, invisible storm that has been building for years. Welcome to the new reality of U.S. banking. Everything looks normal on the surface. Branches open. ATMs work. Headlines are quiet. But behind the scenes, the structure is unstable. Deposits are moving silently. Bonds and loans sit underwater, hidden from view. Investors are adjusting portfolios in ways most people won't notice. This calm is the danger. Calm is what convinces most people nothing is wrong, and that's exactly when crises start. Bank runs no longer happen in lines outside branches. They happen in apps and online transfers. Money quietly exits accounts. Corporations move millions. Ordinary depositors follow suit when they notice subtle trends. It's rational. It's invisible. It's deadly for banks unprepared for instant liquidity stress. Banks cannot raise deposit rates fast enough to keep money from flowing out. Why? Because their assets are locked in long-term bonds and loans at lower interest rates. Paying higher interest to depositors would create immediate losses. Keeping rates low causes outflows. Either way, the math is against them. This is the yield trap, and it's growing every day. Banks are carrying enormous unrealized losses on bonds bought in the low interest rate era. These losses are invisible until forced to sell. When liquidity stress forces sales, losses become real overnight, creating cascading effects across balance sheets. This is the silent ticking bomb no one is watching closely enough. Commercial real estate is the invisible fracture in the system. Office spaces, hotels, retail centers, and industrial parks face falling values and higher refinancing rates. As loans mature, many borrowers cannot refinance. Banks must either extend loans or recognize losses. Both options create growing tension. This is extend and pretend at scale. Trillions of dollars in commercial real estate loans are scheduled to mature over the next few years. Each wave brings new stress, forcing banks into decisions that will determine solvency. The maturity wall is not theoretical. It is scheduled, unavoidable, and growing. Regional banks hold the majority of these CRE loans. They have less capital flexibility and weaker deposit bases than larger institutions. This makes them the first to feel stress, often silently, before it spreads to larger players. The system is interconnected, but vulnerabilities are concentrated. Unlike dramatic collapses of the past, this crisis will appear boring. A dividend cuts, emergency capital raises quiet mergers, Friday night failures. It will look gradual until one day, the scale of disruption becomes undeniable. Forget headlines. Watch. Bank deposit flows. Commercial real estate delinquency rates. Money market fund inflows. Federal Reserve liquidity usage. These numbers tell the real story before markets and media realize what's happening. Bailout banks and inflation and moral hazard worsen. Do nothing and the system contracts violently, credit dries up, and the economy slows. There is no painless solution. Every path carries consequences. The most dangerous moment in any financial system is when everything seems calm. Right now, that calm exists. Recognize it, understand it, prepare for it. Because when the system shifts, it will feel sudden, but it will be the result of slow, predictable mechanics. The U.S. banking system has quietly transformed in ways most people will never notice until it affects them directly. On the surface, everything appears normal. ATMs function, branches are open, headlines remain calm, and the stock market seems steady. Yet behind this serene exterior lies a complex network of financial pressures and hidden risks that could trigger significant disruption if ignored. Deposits are shifting faster than ever, not out of panic, but rational optimization, with corporations and individuals alike reallocating cash to money market funds and short-term Treasury securities to capture higher yields. Banks, meanwhile, are trapped in a delicate balance. Their long-duration assets, purchased during periods of low interest rates, have depreciated significantly in market value, but accounting rules allow these losses to remain unrealized until forced to sell. This creates an invisible tension in their balance sheets, a tension that grows with every month of low deposit inflows and every increase in refinancing rates for commercial loans. Regional banks are particularly exposed, holding a disproportionate share of commercial real estate loans, many of which were issued under assumptions that no longer hold. Office buildings struggle with vacancies. Retail centers face declining foot traffic. And multifamily units see fluctuating rents, creating a landscape where refinancing is increasingly difficult and defaults become more probable with each passing month. As loans mature, banks are faced with impossible choices: extend credit under unfavorable terms and hide the losses, or recognize those losses and potentially trigger a wider liquidity crunch. The interconnectedness of the financial system amplifies these challenges, as the failure or weakness of one institution can quickly reverberate across the sector, impacting counterparties and triggering further withdrawals. Meanwhile, the regulatory environment offers only temporary relief. Central bank liquidity facilities can provide short-term support, and forbearance can prevent immediate recognition of losses, but these measures cannot change the underlying economic realities. Investors, depositors, and financial managers who focus only on headlines or traditional metrics risk being blindsided by these subtle yet potent dynamics. Every movement of money, every shift in deposit composition, and every change in the valuation of long-term assets carries amplified consequences in this fragile equilibrium. The silent nature of these shifts, combined with the rapidity enabled by modern financial technology, means that by the time obvious signs of trouble appear, the system may already be under considerable strain, leaving little time for corrective action. Understanding these mechanisms requires an appreciation of incentives, structural interdependencies, and the mathematics of liquidity rather than relying on superficial indicators. As commercial real estate pressures continue to build, especially with trillions of dollars of debt approaching maturity in the coming years, the ability of banks to manage cash flow and capital adequacy will be continuously tested. Even small misalignments or delays in recognizing losses can cascade into broader systemic effects, influencing credit availability, interest rates, and investor confidence across multiple markets. The dynamics are further complicated by behavioral factors. Rational actors respond to incentives in ways that can magnify stress, such as preemptive withdrawals or cautious lending practices, which in turn reinforce the challenges faced by banks. In this environment, conventional metrics like capital ratios or short-term earnings reports offer an incomplete picture. Real insight comes from monitoring deposit trends, refinancing rates, delinquency statistics, and liquidity facility usage in tandem. The scenario that unfolds is neither sudden nor chaotic in appearance, but the underlying shifts can culminate in a rapid adjustment phase where asset valuations, funding costs, and credit flows recalibrate sharply, producing outcomes that are mathematically predictable, even if visually inconspicuous. This is a landscape defined by invisible tension, delayed consequences, and systemic interdependencies where the actions of individual institutions are amplified across the financial network. By focusing on these forces and understanding the mechanisms at play, it becomes possible to anticipate the timing and potential severity of disruptions, to prepare strategies that are proactive rather than reactive, and to maintain clarity amidst an environment that rewards those who see beyond surface level stability. Observing these patterns requires patience, analytical rigor, and a willingness to track the often overlooked yet critical data points that signal stress accumulation. From subtle shifts in deposit behavior to incremental changes in loan performance, and asset valuations. Those who pay attention to these indicators gain a significant informational advantage, positioning themselves to respond intelligently to unfolding developments rather than being caught off guard by ostensibly sudden events. Ultimately, the story of the U.S. banking system in this period is not one of dramatic crashes or headline-grabbing collapses, but a narrative of slow, moving structural adjustments, hidden vulnerabilities, and the accumulation of pressures that will shape the system's trajectory in profound ways. Every decision made by banks, regulators, and market participants interacts with these forces, either mitigating or exacerbating potential outcomes, creating a dynamic where foresight and disciplined observation become the most valuable tools for navigating uncertainty and maintaining financial resilience. Money is moving quietly, almost invisibly, in ways most people will never notice until it affects them directly. Banks appear stable on the surface, with functioning ATMs, open branches, and calm market headlines, yet underneath, a complex web of pressures is building, unseen and often misunderstood. Every decision made by financial institutions, from lending practices to portfolio management, is interacting with hidden forces that amplify stress and create fragile equilibrium. Deposits are shifting rapidly, not due to panic but calculated strategy, as corporations and individuals optimize for higher yields in money market funds and short-term treasuries, leaving banks in a delicate position where raising interest rates for depositors could create immediate losses, while keeping rates low encourages further outflows. Long-duration bonds and loans purchased in the low-rate era sit on balance sheets with unrealized losses, invisible until forced to sell, producing cascading effects that can disrupt liquidity and capital adequacy. Regional banks are particularly vulnerable, holding the bulk of commercial real estate loans, many of which face falling values, increased refinancing costs, and higher default probability. As these loans mature, banks must choose between extending credit under unfavorable terms or recognizing losses, with both options creating growing systemic tension. This interconnectedness magnifies every action, as weakness in one institution can ripple across the network, impacting funding, credit availability, and investor confidence. Regulatory measures provide only temporary relief, with central bank facilities and forbearance capable of postponing recognition of losses, but not altering underlying economic realities. The flow of money, shifts in deposits, and changes in asset valuations are subtle yet carry amplified consequences in this fragile system. Modern bank runs occur silently through apps and digital transfers rather than public queues, making detection and response slower. Commercial real estate, with trillions in maturing loans, forms a silent pressure point that, combined with regional bank exposure, could accelerate liquidity strain and trigger cascading effects. Understanding these dynamics requires attention to incentives, structural interdependencies, and liquidity mathematics rather than reliance on surface-level metrics or headlines. Behavioral factors, such as preemptive withdrawals or cautious lending, reinforce systemic stress, creating feedback loops that intensify pressure even in the absence of obvious signals. Observing real indicators, deposit flows, refinancing rates, delinquency statistics, liquidity facility usage provides actionable foresight into potential disruptions. The system's calm appearance masks invisible tension that can culminate in rapid recalibration of asset valuations, funding costs, and credit flows, producing outcomes that are mathematically predictable yet visually subtle. Navigating this environment successfully demands rigorous monitoring, disciplined analysis, and a readiness to act proactively, as conventional metrics alone cannot reveal the full extent of vulnerabilities. The interplay of hidden losses, liquidity dynamics, regulatory interventions, and market behavior defines the current banking landscape, where small adjustments can produce amplified consequences